Aisyah binti Badarudin.
Assalamualaikum and hi, my name is Anis Mardiah binti Kamaruzaman.
Hi and Assalamualaikum, my name is Cik Syafiqah binti Syazha.
Hi, my name is Nurul Aina Natasha binti Ramli.
Hi and Assalamualaikum, my name is Nurul Aina binti Zakaria.
Hi and Assalamualaikum, we are from Group 3 and now we will be presenting question 1C, which is the consolidated statement of profit or loss and other comprehensive income for Great Berhad Group together with question 4. Now, I will begin the presentation by explaining the consolidated statement of profit or loss and other comprehensive income. Firstly is the revenue, where we sum up the revenue amount from Great Berhad, Big Berhad, Excel Berhad and Good Berhad without having to apportion the amount since the ordinary shares of each subsidiary company was acquired during the beginning of the accounting year. Then, the revenue was being minus with 60 million ringgit and 30 million ringgit, which is the result of intercompany transaction. Based on the additional information given, it was stated under the intercompany sales and purchases that Great Berhad sold goods to Big Berhad and Excel Berhad at an invoice price of 60 million ringgit and 30 million ringgit respectively. Therefore, intercompany transaction arises between Great Berhad and Big Berhad amounted to 16 million ringgit and intercompany transaction between Great Berhad and Excel Berhad amounted to 13 million ringgit must be eliminated against the total revenue of subsidiary companies. Next, the cost of sale is a sum of cost of sale amount from Great Berhad, Big Berhad, Excel Berhad and Good Berhad minus with 60 million ringgit and 30 million ringgit, which are the intercompany transaction between Great Berhad and Big Berhad and between Great Berhad and Excel Berhad that was mentioned earlier. And then, plus with the unrealized profit arises from the intercompany transaction amounted to 5 million ringgit and 2.5 million ringgit. It was given in the additional information that 50% of the inventories managed to be sold to third parties by Big Berhad and Excel Berhad. And the accounting policies for Great Berhad Group stated that they always sell their goods at a markup price of 20% on cost. The calculation of unrealized profit amount for the sales of goods is as shown in the slide. For the intercompany transaction between Great Berhad and Big Berhad, we have to multiply 60 million ringgit with 50% and 20% over 120%, which we will get the 5 million ringgit. And for the intercompany transaction between Great Berhad and Excel Berhad, we have to multiply the 30 million ringgit with 50% and 20% over 120%, which we will get 2.5 million ringgit. Therefore, these two amounts is bring to the consolidated statement of profit or loss and other comprehensive income under cost of sales to be added up. Now, we will move on to gain on disposal.
Moving to the next part, we need to add the gain on disposal amounting to 4.5 million. The gain on disposal amounting to 4.5 million we get by add 15 and 6 million from the statement of profit or loss given and minus 12 million from URP profit from sales of machine by grade and 4.5 million from URP profit from sales of motor vehicle by Excel. This is the calculation on sales of asset where we get from the question which 12 million from sales of machine grade and 4.5 million from the sales of motor vehicle axles. We also need to calculate the depreciation by divide with the years remaining. Meanwhile, we also need to add the investment income amounting 18.9 million. For the investment income amounting 18.9 million, we get by add the amount from the statement profit or loss given, which are 36 and 50 million. Then, minus the ordinary share dividend received from Big to Great amounting 11.7 million, from Excel to Great amounting 12 million, and from Good to Big amounting 4.8 million. We also need to minus 3.6 million, which are debenture of interest received that Great acquired from Excel. For the dividend received from Big to Great amounting to 11.7 million, we get by times the direct control of 75% with ordinary share dividend payable 15.6 million. Same goes with dividend received from Excel to Great, where we times the direct control of 80% and ordinary share dividend payable 15 million. And also from Good to Big, which 80% times with 6 million. For the debenture interest received, we need to take percent of control debenture that Great acquired, which is 30%, times with 12 million of debt interest paid by Excel. Next, we move to expenses. We need to minus the expenses that amounting to 118.5 million. The amount of expenses, 118.5 million, we get from add the amount from statement profit or loss given, which are 15 million, 36 million, 24 million, and 9 million. Then we need to minus the depreciation from sales of machine grade and sales of motor vehicle Excels amounting to 3 million and 1.9 million respectively that we have calculated above. Also, we need to minus the debenture interest that Excel need to pay to Grade amounting to 3.6 million.
Now, let's move on to the share of profit of associate. Referring to our calculation, the figure that we get is 1.97 million ringgit Malaysia. This is the calculation of getting share of profit of associate at 1.97 million ringgit Malaysia. At first, we need to determine the retained profit for the year, which is 2.25 million ringgit Malaysia. This figure is obtained by 18 million multiplied with 6/12 multiplied with percentage of associate, which is 25%. In addition, we also need to less unrealized profit from the downstream transaction, which is 0.33 million. However, don't forget to multiply the figure with percentage of associate and it will result to 0.08 million. Moreover, there is also impairment at the end of the year at 200,000 ringgit Malaysia. Hence, the total of post-return profit 2.25 million minus with unrealized profit downstream 0.08 million minus with impairment at 0.2 million will get 1.97 million of share profit of associate. Moving on to the impairment on goodwill, which we need to minus 1.65 million. This figure is obtained based on calculation of determined goodwill or bargain purchase of Big Berhad. Since the calculation resulted to goodwill at 16.5 million, there is 10% impairment made in the year ended 31st December 2021, which is at 1.65 million. This figure will include it in consolidated statement profit or loss since the transaction is included in the current year. After that, we will get profit before tax, which is 215.72 million ringgit Malaysia, and need to subtract with taxation of the year, which is at 63.6 million ringgit Malaysia. This adjustment had been made based on the figure provided in the question. Hence, it will result to profit after tax at 152.12 million ringgit Malaysia. Now, let's take a look at the other comprehensive income. The first element that we had is gain on acquisition. This figure, 31.68 million, is obtained from calculation gain on second acquisition of Excel Berhad. Next, increase in revaluation is at 24.7 million, which resulted from adjustment of 700,000 of revaluation at the end of the year of Good Berhad's freehold land. Thus, the total comprehensive income that we obtain is 208.50 million ringgit Malaysia.
From the consolidated statement of profit or loss and other comprehensive income of Great Berhad, it was stated that the profit after tax PAT at the end of the year is 152.12 million and the total other comprehensive income TCI is 208.5 million. This PAT and TCI are then attributed to the holding company's share as well as to the non-controlling interest NCI. To calculate the PAT attributable to the share of holding company will be the balancing figure after deducting the NCI portion of the subsidiary's PAT. The calculation of the NCI can be referred to working 1, where we are required to calculate the shares of NCI in the PAT of each subsidiary. As for Big Berhad, its PAT of 54.6 million will be deducted with the preference dividend paid of 14.4 million. Since Great does not acquire any of Big's preference share, therefore the NCI portion of the dividend is 100%. After deducting the preference dividend, the remaining PAT will be 40.2 million. It will then be multiplied with the Big's NCI portion of 25% and we will get 10.05 million that will be added with the 14.4 million preference share dividend. Hence, the total NCI of Big is 24.45 million. Next, the PAT of XL Berhad of 45.6 million will be deducted with the unrealized profit earned of 4.5 million from the disposal of motor vehicle. Then it will be added with the depreciation over provided of 0.9 million. The remaining PAT of 42 million is multiplied with XL's NCI portion of 20%, and therefore the NCI of XL will be 8.4 million. Lastly, Goods Berhad PAT of 27.3 million that is not affected by any adjustment will be multiplied with its NCI portion of 40%. Thus, the NCI of Good is 10.92 million. All of these NCI portions are added, resulting to a sum of 43.77 million. The figure of 43.77 million calculated earlier will be transferred to the NCI under the PAT attributable to in the consolidated statement of profit or loss. It will be deducted by the profit for the year of 152.12 million, and hence the share of the holding company assessed was 108.35 million. Regarding the TCI attributable to, the NCI of 44.05 million was calculated by adding the PAT NCI portion of 43.77 million with the NCI portion of the current year revaluation of 0.28 million. Finally, the holding company's share in TCI of 164.45 million was assessed by deducting the current year comprehensive income of 208.5 with the NCI of 44.05 million.
Now I will continue the presentation with question 4. Plankton is a wholly owned subsidiary of O&O Berhad. On 1st April 2021, Plankton purchased 26,000 ordinary shares out of 104,000 in Sandy Berhad for 8.5 million. Plankton had the right to participate in the policy-making process and interchange of managerial personnel of Sandy Berhad. To answer this question, I will now explain the relationship between Plankton Berhad and Sandy Berhad with reference to MFRS 128 investment in associates and joint ventures. MFRS 128 defines an associate as entity over which the investor has significant influence. Significant influence is a power to participate in the financial and operating policy decisions of the investee, but not control or joint control of those policy. An investor is presumed to have significant influence over the investee if the investor holds directly or indirectly 20% or more of the voting power of the investee, unless it can be clearly demonstrated that this is not the case. In this situation, according to MFRS 128, Plankton should treat Sandy Berhad as its associate company as it owns 25% interest in Sandy Berhad. And Plankton also has the right to participate in the policy-making process and interchange of manager personnel of Sandy Berhad. Therefore, investment in Sandy Berhad will be treated as investment in associate and should be accounted under equity method. Under the equity method, the investment in associate company is initially recorded at cost and subsequently adjusted to reflect the investor's share of the net profit or loss of the associate. The difference between the cost of investment and the fair value net asset of associate on DOA will be recognized as goodwill or bargain purchase. However, the goodwill or bargain purchase is not disclosed separately but will be included in the carrying amount of the investment. Now we have come to the end of our presentation. Wabillahi taufiq wal hidayah. Wassalamualaikum warahmatullahi wabarakatuh, and thank you for watching.